Josh Young joins us now, Chief Investment Officer at Bison Interests. Josh, I've been dying to get your take on all of this, what we heard from OPEC today. We keep hearing about the need for more supply because demand is so robust and could grow over the winter months, yet OPEC pretty much just holds the line. What do you think's going on there?
Yeah, so we put out a white paper a few weeks ago and got scheduled to talk to you guys about it. And I guess it's playing out a little sooner than we expected. Our take is that OPEC doesn't have as much spare capacity as they've said. And so what we're seeing is they have this calendar to bring production back online in kind of an orderly manner. And we think that once they get production back, as they've planned 400,000 barrels a day every month increased through early next year, that may actually be close to the limit of their spare capacity. So I think it might actually be technically difficult for them to bring a lot more production on. And I think oil prices might be a lot higher as they finish their expansion of capacity and of production through early next year.
Right, that's a fascinating idea, the fact that people just thought OPEC Plus could open up the spigots whenever the world needed it, so not to worry too much. But you're saying that is not the case. Obviously, for our energy portfolios, higher crude, we're seeing a rally in the big energy names today, and that benefits us. But on the other side, the economic recovery, at what point does it get into some trouble because OPEC can't open the taps and crude prices keep going higher?
Yeah, I mean, this is something actually we've talked about before here on BNN, where we've seen ability for consumers to pay a lot more money than they're paying right now for gasoline prices. And if you look at how energy has repriced over time versus housing or some other sectors, oil is lagging materially on an inflation-adjusted basis. So actually, I think we could see much higher oil prices without actually having too much of a negative impact on the economy. But like you were saying earlier, I think it could actually negatively affect technology stock prices and other sort of growth stock prices as companies that have earnings many years in the future are discounted more heavily based on dollars and Canadian dollars maybe being worth a little less in the future than they are right now.
In the past several days and several weeks, we've been hearing about the natural gas crunch in Europe. We heard China apparently directing its big state-run enterprises to stock up at all costs. So what kind of pressures could that unleash on the crude market? People don't think the natural correlation between high coal prices or high natural gas prices, but could that set off even more pressure upward on oil?
Yeah, I mean, our generation's greatest energy trader, John Arnold, actually tweeted today that he sees us bumping up against production limits across energy commodities. And so I think what we're seeing is potential significant additional demand for oil for power generation, with generators all around the world getting bought and now redirected to places where they're being used to burn diesel or to burn fuel oil to generate power or to supply backup power either to wealthy or places that have the resources to be able to afford that, or to wealthy people or to companies that really feel like they need to have access to uninterrupted power. I think it's something that we've kind of just taken for granted across the modern world. And it's something where eventually, if you invest in unreliable technologies like solar and wind and underinvest in reliable power sources like coal, oil, natural gas, and so on, you end up in a situation like this where you can end up with just too little power and Chinese cities in the dark.
Could this be a bigger problem for the global economy? When you talk about the fact that we are trying to transition to cleaner energy sources, but there is a concern, obviously, in recent days and weeks as well, that it's going to be a messy transition. It's not going to be as smooth as we'd like. You'd like to think, oh, if we're going to get off of this, then here's the next one just flowing into my house, not going to miss a beat. Are you worried that we're going to miss a beat?
Yeah, I mean, I think it's like kind of scary, this kind of utopian idea of switching over to a new thing without really testing it and turning off old things without kind of fully proving that the new things can be reliable over a variety of circumstances. So we're seeing that they're not reliable. And so I think what we're actually seeing is maybe bigger than hiccup in the energy transition. Like maybe we don't transition to just wind and solar because maybe they just can't deliver what we've been hoping they deliver. And I think we're seeing maybe some early stages. We saw this in February in Texas, where there were blackouts and where solar and wind only delivered 14% of their headline rate. And so, there were also other issues there. But, I think it's really risky with something that's as necessary as flipping a light switch and having the power come on or having heat in the winter. I think it's really risky to turn off coal power plants, really risky to turn off natural gas power plants before being able to prove that that won't be an issue. And we're unfortunately seeing that it is an issue. So yeah, risk to the global economy. But I think really what we're seeing right now is kind of this shift from growth stocks to value. And we're seeing a reflation. Energy stocks have a long way to go to get back to where they've been in past cycles. I think we're only at 2 or 3% in the S&P. They've been as high as 20%, I think even maybe a little higher. And so I think we're just starting to see this transition in valuations rather than, I think, a transition in energy sources.
Well, Josh, I'm almost out of time with you, but I did want to get your ideas about one name in particular, given all this. Baitex Energy. What do you like here?
Yeah, I mean, so I think the street's been wrong about this. And after they got delisted in the US from the New York Stock Exchange, they've just been a TSX listed name. Canadian investment banks, I think, have been a little disappointed that they haven't been acquirers. Baitex has organically identified, explored, and is now developing one of the most economic oil fields in the world, where they get payback in terms of maybe 2 or even 3 months with the top performing wells in the Clearwater. So with great wells and without like a lot of research support and without a lot of like top buy ratings or picks or whatever by Canadian investment banks and by fund managers, there's been this opportunity for retail and for smaller funds like Bison to be able to come in and buy Baitex at a big discount. And so I think people don't really appreciate how valuable these fields are that Baitex has discovered and is developing, as well as I don't think people appreciate kind of these conflicts that are embedded. Like there's a huge value in doing your own work, and Baitex at higher oil prices like we're seeing may have some of the most torque and is way better positioned than competitors that it's typically compared to.